You can ask 100 economists what's taking place in the economy today, you're probably going to get 90 answers. If you ask 100 technicians what's taking place in the market today, you're probably going to get 5 or 10 different answers, right? So a much tighter spread of outcomes. And I think that's really, really important.
The PPI data suggests we might be experiencing deflation of all things. Labor data revisions were the worst in history, and the Federal Reserve is about to start slashing interest rates, all while gold and stock market prices keep putting in all-time highs. Hello and welcome to Milk Road Macro, the podcast that is here to remind you that even though nobody knows what's going on in macro, it's more fun to be confused together. I'm your host, John Gill, and today is Wednesday, September 10th, and we are joined today by the Wonder Kid himself, Caleb Franzen. Caleb is a financial analyst and founder of Cubic Analytics, where he provides in-depth research on macroeconomic trends, the stock market, and Bitcoin. Caleb quit his corporate job to launch his own independent research on X and Substack back in 2020 and has become a bit of a legend since then. Caleb has brought some exclusive alpha, a lot of great insight to share with us all today. I can promise you, you're not going to want to miss this, so make sure you like and subscribe, share this episode with somebody who's going to enjoy it. And as a reminder, our Milk Road Macro research team lives and breathes macro. Every month, we drop a sharp, no-fluff report on what really matters in macro, break down everything you need to know in a way that you can understand it. Join our pro community today to get in on that alpha. The link is below in the show notes. And today's episode is brought to you by KGeN, the verified distribution protocol changing the growth game. Make sure you support our wonderful sponsors at KGeN. Check them out. They're doing great work. And without further ado, welcome to Milk Road Macro. Caleb Franzen, how are you, sir?
John, that was a high pressure introduction there, man. Legend, Wonder Kid. Come on, man. We got to temper it down a little bit.
Look, I think overpromise, underdeliver is also a good way to go, but underpromise, overdeliver, any way you want to do it. Look, I'm really excited to have you here. You've made quite a name for yourself. I think really where I would like to start is just to at a high level, what's going on in the market, but based on the recent news as well, right? So the producer price index data came out. It was a sharp decline, shocked a lot of analysts. It was below what everybody was forecasting. We even got a negative print for one of the months, which was kind of wild. So that's going on. At the same time, just recently we got the highest all-time high negative revision in labor market data. I want to get this right. We between April of 2024 and March of 2025 added almost 1 million. It was 911,000 jobs were revised down out of the data, which wipes out half of the economic growth in terms of jobs added in the United States during that period. Frame for me where we are in the market right now. Things are pumping following the PPI data. The jobs data looks terrible. What are you seeing in the markets right now? Tell me what you're thinking about all this.
Look, I think every single market environment ever always has risks. And so today is no different than basically any other time in history. So, just kind of setting it up there based on the framework that you provided. Yes, we had PPI inflation, at least on a month over month basis, come in significantly lower than expectations. I think the market was looking for 0.3% month over month inflation for PPI, came in at negative 0.1. So a huge downward miss. I think the important thing to really contextualize and remember here with the PPI data is that tariffs are not going to have any impact on this because it's domestic producers. It has nothing to do with imports, right? So that's first and foremost. And the CPI data tomorrow is really going to, in my opinion, trump what's taking place today with PPI. I'm hoping that CPI comes in cooler than expected. And if that's the case, I mean, the market trend today is giving us a pretty clear-cut signal. But I think irrespective of even what's taking place today, we've been in a market uptrend for quite a while now. It's not a secret. And so all we're seeing today is a continuation of that uptrend, right? And typically what we generally expect is that macroeconomic data and the response to macroeconomic data is going to resolve in the direction of the underlying trend. We're in an uptrend, macroeconomic data comes out, we continue to go out in an uptrend. And so, I also want to tie that back into what you mentioned about labor market conditions, because yes, we did see 991,000 jobs cut out of the picture, right? That's the largest revision in US history, as you mentioned. But I also want to contextualize, this time last year, we also got the second largest downward revision in economic history in the United States. And we were in a pretty strong bull market thereafter, right? And so, I've listened to your guys' podcast for a while now. One of the things that I can't remember if you mentioned it, John, or someone else, but the economy is not necessarily the stock market, right? And in fact, I generally tend to emphasize what's taking place in the stock market much more than what's actually taking place in the economy. I put myself as a technician above being an economist because I fundamentally believe that asset prices are the best crystal ball that we have available to us. And so we should lean into that as much as we possibly can, right? It goes back to Finance 101, Econ 101. Asset prices are just a discounting mechanism. They're the net present value of future cash flows. And so a lot of people criticize technical analysis. They criticize people who just default towards the underlying trend because they say, oh, you're only focused on data from the past. Unfortunately, none of us have data from the future, right? That's all we have is data from the past. So sue me if I'm going to be using data from the past. Please don't. I'm kidding about suing me. Please don't. But all we have is data from the past.
The lawsuit's on the way.
Yeah, exactly. So,
well, okay. So I want to. You just jumped a lot of alpha there. I want to kind of break that down. First of all, the person who said that quote you're referencing was Quinn Thompson. So if anybody missed that episode with Quinn, definitely go back and check it out. There's a lot of great alpha insights in that. But what Quinn was talking about is what you're referencing is that the market right now, the valuations of assets are deviating a lot from the macroeconomic indicators about the health of the economy. We're seeing this disparity happen, right? Like a lot of this data seems to suggest that the economy is not very healthy. At the same time, the market's going to all-time highs. You said like things are going to revert back to the trend. We're in a macro uptrend. Show me some of the data that you're looking at that's kind of supporting this thesis, like because I feel like a lot of investors are saying that some of the economy or some of the market is doing really well, but a lot of it is not. How are you kind of parsing that? What are your thoughts on that?
Yeah, so the economic data that's important to the stock market is actually showing really good signs. So if we look at forward 12-month earnings for the S&P 500, for small caps, whatever the case is, they're all making new all-time highs. So if, again, asset prices are just a function of future cash flows, and we measure those cash flows by expectations of earnings per share in the future, that's giving us a really solid backdrop to keep trending higher. But let's actually just look at the data itself. Let's look at what the stock market is doing. I know it's super unsexy. I know it's the most boring index that we have in the United States. It's a price-weighted basket of 30 stocks, and most of them tend to lean a little bit more value-oriented, but this is the Dow Jones Industrial Average. What do we notice about this chart? After we make new all-time highs following a multi-month or multi-quarter consolidation, we tend to resolve higher. Strength begets more strength. And so as we're looking at this chart recently breaking out to new all-time highs, it's irresponsible to not expect us to keep trending higher and reach that 161.8% target extension. By the way, with today's price action, that target extension is about 10 to 11% away. And so I think that's really, really important. Guys, I'm about to drop a bunch of charts right now. So I'm like, seriously, buckle up, because it's not just the United States that's making new all-time highs. We can look at emerging markets ex-China breaking out of a 4-year base. I don't care what the reasons are, what the justifications are. Investors worldwide are getting so optimistic about the future that they're valuing emerging market stocks at the highest price ever. That does not tend to happen during bear markets. That does not tend to happen during recessions. We can look at value stocks doing basically the same exact thing, breaking out to new all-time highs. We can look at high dividend stocks. This is VYM, breaking out to new all-time highs. Do we notice anything about these charts so far? First of all, they look very similar. Second of all, when we get these breakouts to new highs, they tend to beget more new highs. Let's look at dividend growth stocks, specifically high dividend growth stocks, new all-time highs. We can look at cash flow growth stocks making new all-time highs. By the way, I included the top 10 holdings of this ETF in the bottom right corner. One of the things you're going to notice, there's not much mega cap tech in this basket, right? We're talking about Delta Airlines, Uber, ResMed, Booking Holding, United Airlines, Salesforce, Airbnb, NRG, Pulte Group, and MCore. I'm sure a lot of investors have actually never even heard of some of those individual names. So this is the backdrop that we're in. And I told you, buckle up, we're going to keep going. We have momentum stocks making new all-time highs. We have NASDAQ disruptor stocks making new all-time highs. We have quantum computing stocks, new all-time highs. We have cloud computing stocks, new all-time highs. We have semiconductors, new all-time highs. And look, as we think about kind of the cyclical areas of the market as well, because we just rattled off a bunch of the growth-oriented, high beta-oriented aspects of the market, we also have retail stocks making new all-time highs. If investors were really concerned about the US consumer, do you think that retail stocks would be in a 3-year uptrend making new all-time highs? I don't think so.
All right. So I think you just went through a whole bunch of stuff. I want to kind of slow down a little bit and kind of
Sure.
unpack some of this for the audience. There's a lot of great alpha in here, and I appreciate the kind of broad view you're bringing to this. Right, you're not just showing one chart; you're showing a lot of different ways of looking at the market and showing that we've seen strength. We are expecting to see continued strength. That all makes sense. I think I want to take this back to a question about like hyperscalers, right? So like you're talking about a lot of these growth stocks, and a lot of people are saying that AI and hyperscalers, a lot of these like the Nasdaq disruptors, right? That was one you showed. That's kind of an example of like some of these companies that are benefiting a lot from this capex and from a lot of the enthusiasm around that. At the same time, though, a lot of investors are saying that, hey, we're at all-time highs, but a lot of these things are really overvalued. What makes you so confident that we're going to see all of these like overvaluations continue and not see some kind of a correction or pullback, right? Like that's kind of something I think a lot of people are wondering right now.
By the very nature of the fact that we're in an uptrend. And so we know for a fact that asset prices trend. And so as of right now, all I see is the production of higher highs and higher lows. And by the way, it's not just the hyperscalers, it's value stocks, it's high dividend stocks. This is going to be a lot of pharmaceuticals, it's going to be a lot of healthcare, it's going to be some energy, it's going to be some industrials, so on and so forth. I mean, there's probably not a lot of hyperscalers in emerging markets ex-China, right? So when we're thinking about the context of all of these charts, this is why I try to make it as broad based as possible, is because we're seeing participation in the market irrespective of the theme, right? And so that's what's really important. Of course, the trend can change, right? So it's our responsibility as investors, even as economists, to think about the market, to check in on it daily, weekly, monthly, to reaffirm that these conditions are still intact.
Yeah. Okay. So I think, so to kind of like tie this up, I want to ask you some questions about the Fed, about interest rates, about what you're seeing there, what you're expecting for inflation there. But just kind of like synthesize this a little bit for the audience. A lot of the data that we're seeing, macroeconomic data on employment, on inflation, all these things, they're data about the past, as you said, right? We don't have data from the future, so it's kind of backwards looking. And this huge negative revision to the jobs data, this goes all the way back to April of 2024. So it's really telling a story about where we've been, economically speaking, not necessarily where we are or where we're going. So I think that's important to keep in mind, because usually what happens with a recession, you don't know that you are in one usually until you're well past it and out of it, right? And so what I've heard said by some analysts recently is that some of this data kind of indicates that we might have gone through some version of a contraction, a recession at some point in the prior year, but that we're likely through it. So let's kind of look ahead, right? So like what we're expecting, what a lot of the market is expecting, is a 25 basis point rate cut from the Federal Reserve next week at their FOMC meeting. Some people are now calling for as high as 50 basis points. Some people are calling for more than that, although I don't think they're going to get it. I'd like to hear what your thoughts are for how the market is going to digest that, because usually speaking, the people view rate cuts as bullish for the market. However, sometimes the market doesn't react in the same direction. I don't want to get too far ahead of us, but you wrote a great piece on Substack recently called "These Rate Cuts Are Different." So just frame for me, are you expecting 25 basis points, 50 basis points? Does it matter? How is the market going to digest this? And what's your outlook going forward from here?
I love this question. So first of all, it doesn't matter whether the Fed cuts 25 or 50. It actually doesn't even matter if they cut in September. We're in an uptrend like we just observed, right? And so by the very nature of being in that uptrend, I think it's irrespective. Let's also frame it this way too, right? The market was pricing in rate cuts earlier this year, and those kept getting pushed out further and further into the future during a time where we stayed in an uptrend and asset prices continue to make new all-time highs. So the market has not been dependent on imminent rate cuts. They've just been dependent on the fact that rate cuts are coming at some point relatively soon. That's been the key here. And so as I look at the market being the best arbiter of truth that we possibly can, I'm sharing my screen here on this. What we're looking at in this chart, in blue is the 1-month treasury yield, in red, the 3-month treasury yield, and in green, the effective Fed funds rate. And so because the market is the best forward pricing mechanism that we have at our disposal, we can actually see how good is the bond market, specifically the short duration bond market, at determining what the Fed is likely to do over the next 1 to 3 months. And so with both of these variables, the 1-month and the 3-month treasury yield falling well below Fed funds at this point, we are unequivocally now priced for a rate cut at this point, and it looks like it's going to be coming in at 25 bips. I don't think we're going to be getting 50. You could even see down here, someone had asked me, will it matter if it's 25 or 50? I genuinely don't think it does. in terms of supporting the economy. Is the market going to matter or react to that data? Yeah, I think it will. And in fact, it's probably just going to react more bullish if we get 50 than anything else, the same way that it was bullish when the Fed cut 50 basis points last year, right? So that's really the context and the environment that we're in here. Is the market is now priced for another rate cutting cycle. And maybe that changes in 3 months down the line and we go through another pause. Maybe that changes 6 months down the line, we go through another pause. We don't know. But right here, right now, this is looking pretty solid.
So I want to highlight something for the audience here. In a prior episode we did with Professor Robin Hanson, who has worked for 30 or 40 years at this point in prediction markets, he highlighted something that I thought was really valuable. He said that markets are used for speculation on financial assets and for investment, but they are also a information generating machine. And what this chart is showing is just that happening, right? The market is telling you that it is predicting the Fed is going to lower their interest rates, and it's telling you by how much too, right? So like this is a way that people are voting with their capital, they're speaking with their capital and telling us what they're expecting to have happen. Same thing that happens we saw on the other charts that Caleb just showed us, right? Like he's saying that the market is telling us that it's expecting a breakout, that it's expecting this bullish momentum to continue. So I think that's something to remember for our audience, is that the market is not just a way to, buy and sell and trade and make profits and losses. It's also an information generating machine, and it's telling you what the market is expecting, what the market thinks is going to happen, and it's more often than not right. And it beats experts on a lot of these things. So let's get to that Substack article. These rate cuts are different. Why are these rate cuts so different in your mind? What is so distinctive about this situation or this policy change? What do investors need to understand about that?
Sure. So last year, I was talking about the rate cut environment as being unequivocally bullish. I'm still bullish today because, again, I'm a technician before I'm an economist. And so when I look at the weight of the evidence, when I look at intermarket relationships, when I look at trends, when I look at statistical indicators, all of those components are telling me that I have to have an upward bias in this market. But what's very different today versus what was taking place last year is two separate things. So let's tie both of these in here. First and foremost, last year, I was saying that rate cuts were going to be very bullish for basically one and or two reasons. The first is that we were in a disinflationary environment. So what I want everyone to do is just focus on the chart here up at the top. This is what the inflationary picture looked like when the Fed was getting ready to cut rates last September. So this is data as of August of 2024. At the time, that was the most up-to-date inflation data that the Fed had available at their disposal. And at the time, when we're looking at median CPI, trimmed mean CPI, headline CPI, or core CPI, all of them were decelerating on a year-over-year basis. That's why I was calling them disinflationary rate cuts. The Fed was not cutting interest rates to respond to a financial crisis or a recession. They were cutting interest rates because they were moving closer to their 2% target, right? Remember, Powell was saying we need to see the whites of inflation's eyes. Based on this trend at the time, the Fed had a lot of confidence that they were seeing the whites of inflation's eyes, which gave them comfort to cut interest rates. Let's contrast that here with the chart that I have on the bottom. This is the same exact data point, but looking at it today. What we're seeing today is that all of these components are now starting to resolve higher. In other words, they are re-accelerating. So one of the key points from the newsletter that I published this weekend, These Cuts Are Different, is the fact that we no longer actually have disinflationary rate cuts in the current environment. On the contrary, the Fed is getting ready to cut interest rates into reinflation, or at least reinflation insofar as we know today. So again, this is what I mentioned earlier. The CPI data tomorrow is going to be way more important than PPI for the simple reason that the Fed does not target PPI inflation. They target CPI, right? So that's where, that's really where the meat and potatoes is going to be for the Fed, is in the CPI data. And so when we're looking at this resolving higher, when we're starting to see this reaccelerate back to the upside, that's objectively telling us that these rate cuts are different and that disinflationary rate cuts aren't on the table. And so if disinflationary rate cuts were so bullish in 2024, which was my forecast, I have to be slightly less bullish in the current environment, right? So if something like Bitcoin is up 100% year over year, I don't think we can expect 100% gains over the course of the next year, as much as I would love for that to take place. So, maybe we quote unquote only expect 50 to 70% upside. Maybe we only expect 20 to 30% upside. I'd still be very happy with those results though.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN.
Results, though.
I think this is a really interesting point, and I want to ask your thoughts about this because it seems to me like there's a disagreement happening in a lot of analysts' minds as to whether or not the Fed is just outright admitting inflation is never going back to 2% and giving up on it versus like what you're saying, that this is going to dampen some of this bullish momentum and maybe we're not going to get the same level of a bull run. How do you discriminate between those two ideas? Because I think that obviously the Fed still cares about inflation, but it is also, I think, becoming apparent that they've sort of accepted that it's never going to get back to 2%. Like, how big of a threat to the continued bull run is this reacceleration of inflation, or is it just something we all have to accept as the new reality and we just carry on business as usual?
So oddly enough, reaccelerating inflation is actually somewhat bullish. And I have a chart that I brought with me to prove this. So in blue, we're looking at year over year change in core CPI. And in red, we're looking at the NASDAQ Composite Index going back to the 1970s. And what we generally see is that periods of moderate but reaccelerating inflation, at least measured in terms of core CPI, are coupled with relatively strong asset returns until we reach some point that it actually matters, right? And until inflation gets too high. And so in the current environment, if we are seeing a modest reacceleration of inflation, that for me is not a justification to be bearish. In fact, it's quite the opposite. It's somewhat of a justification to stay bullish in the short term, so long as inflation doesn't get out of control. We don't experience runaway inflation, right? And so that's really the key here. I don't necessarily believe that the Fed has given up on their 2% mandate. I think that they're just becoming increasingly concerned about labor market data. And I think that they generally are trying their best to see through whatever impact these tariffs may or may not have over the course of the next 12 months, right? We've seen several Fed officials come out and say that they think that this is going to be a one-time price adjustment to the upside and that they don't want to get too spooked about reaccelerating inflation if it's just going to be a one-time price adjustment. Because I'll finish off here by just saying one last thing. Let's remember, disinflation or reaccelerating inflation, it actually doesn't matter. The consumer price index itself is still rising. It may or may not just be rising at a slower or faster pace, but we are in an environment basically perpetually, and I think most of the followers and listeners of this podcast would agree, we're in an environment perpetually where prices are going to keep rising. So, the Fed seems to be very comfortable with that. It's one of the reasons why they don't actually target price stability, they target inflation stability.
So tomorrow is when this episode is going to come out. It's also when the CPI data is going to come out, as you've said. What are you watching for from that print, and what should investors be watching for from that print to get some sort of a sense of how the market is going to digest that inflation risk or that reacceleration, and what the Fed is going to be looking for? Walk us through what you're looking for tomorrow.
So what I'm going to be really focused on is this data point right here. It's going to be the consumer price index for all consumers. It's the all items less shelter. Why am I extracting shelter out of CPI? Shelter takes up about 33% of headline CPI, so it's the largest component, and it's also the laggiest component. Per the Fed's own admission, the Chicago Fed has come out and talked about this. The shelter component within the BLS's survey lags actual real-time housing market data by like 8 to 12 months. So it's the largest and the laggiest component. So if we actually want to get a sense for what is inflation under the hood, what are all other components doing within the inflationary basket? What are they doing? This is giving us that representation. One of the things that you'll notice is we've basically been going sideways now for the better part of 2+ years. But the concern here is that it's been reaccelerating since March and April of this year, at least on a year-over-year basis. It's above the Fed's target of 2.1%. Earlier this year, this data point was, I think it was like 1.2% in March and April of this year. So we've reaccelerated very substantially in this data point, indicating that under the hood, most inflationary components are reaccelerating. And that's actually justified by this chart right here, showing the percent of CPI components that are rising faster than 2%. This is the annualized month over month measure of 2%, so it's not necessarily the year over year data point, but we're seeing 68% of components within the CPI basket having an inflation rate higher than 2%. And also this number has been rising and accelerating. So this is a concern for the Fed, but again, it looks like, at least based on what the market is telling us, the Fed is getting ready to cut, not just once, but several times likely over the next several months.
Gotcha. So to just synthesize that a little bit, you're saying that you're taking out shelter because it's the most lagging contributor, and you're looking at this particular metric because it's the most like real time, like of the moment, like indicator of what consumers are experiencing as far as inflation goes, right?
Correct. Because if we look at headline CPI, that's been still showing a solid amount of disinflation. It has been reaccelerating lately, but that's because 33% of the headline basket is influenced by shelter, and shelter has been disinflating because it's data from 12 months ago, right? So this data point right here, headline CPI x shelter, is giving us as best of a real-time pulse that we can get.
Gotcha. Okay. Yeah, this is really helpful information. And I think we're going to have to see what the print is tomorrow, how the market digests it. I think I was really surprised to see the market bounce up so high on the PPI data today. But in general, it feels like there's this like pent up energy in the market where everything is like poised to go higher and break higher. They're just kind of waiting for a signal for that. I want to get your thoughts on something else here. You've put out a lot of analysis and research on Bitcoin. Something that a lot of people have been following recently is this growing divergence between global liquidity, M2, and the price of Bitcoin lagging behind that. Yeah, okay. Well, I guess you're ready to go on this one. Well, I just want to get your thoughts on this because I feel like a lot of people are starting to get nervous. What are you seeing on this? What do you think is going to happen here?
So look, I have some criticisms for a lot of the M2 charts because most of them are some sort of proprietary measure. They're also including data from China, data from India. No offense to those countries, but I tend to have a lower level of trust with respect to what's happening with those central banks. So for me, I would rather just extract those two central banks and look at what's taking place in the M2 of the United States, Japan, Canada, the EU, and the UK. And so in green, that's what we're looking at on this chart, is M2 of all of those countries, specifically the US dollar adjusted amount of M2 in each of those countries. So we're basically doing this in dollar terms. Then I've overlaid Bitcoin on top of that. And so I think a lot of people seem to think that there's this divergence taking place between Bitcoin and M2. And I just don't personally see that, right? I mean, as we look at this chart, they're still moving in lockstep. Maybe the levels have somewhat diverged, but the direction still stays the same. We've basically been seeing global M2 going sideways for the better part of 3 or 4 months. And Bitcoin, generally speaking, has been going sideways for the better part of 3 or 4 months. And so in that backdrop, I'm not necessarily seeing a divergence.
Okay, that's a really succinct answer to that. I think that there has been a ton of liquidity injected by the People's Bank of China, for example, this year. So that is a big driver of that. Maybe that just hasn't found its way into Bitcoin yet. I guess we'll see. So a question I have on this, right, is how do you see this, in Q4, the Fed cutting rates and the changing landscape we're going into? How do you see that affecting M2 and global liquidity? Because I think it's not clear in some investors' mind the direct connection between the Fed lowers one interest rate and what happens next after that. Like, what do you think that the implications for this? How is that going to play out? Is that going to add liquidity, or is that not going to matter? Like, what do you think is going to happen with this?
Yeah, USM2 is going higher, and we could just debate the pace with which it's going to be going higher. I think more recently, I looked at the data, and the year-over-year rate of change in M2 is up like 4 point something percent. I don't remember the data off the top of my head, but it's 4 point something percent. And so that number is re-accelerating, right? So M2 growth, when measured on a year-over-year basis, is both positive. So M2 is rising, and it's rising at an accelerated pace relative to prior months. So that growth should, in theory, cause dollar-denominated assets in and of itself to just go higher, right? We should also be very cognizant of what's taking place in the lending markets, which is that, how should I say this? Total loans and leases in bank credit. That's the official terminology that the Fed uses. Total loans and leases in bank credit is also rising and continuing to rise at an accelerated pace on a year-over-year basis. And so as we think about money leaving the financial system and entering the real economy via loans and leases, not only do we have M2 rising, but we also have credit creation accelerating. That's giving us an environment objectively for liquidity to be on the rise as well.
Yeah, I think that makes a lot of sense. I agree with you completely. It's going higher. It's just the rate of change and the pace of it is the thing we're going to have to see how that plays out. Something I've been really interested in, and I want to kind of get your thoughts on this. because we are in, so it's been a long time since we've been in a market environment where the market has been expecting rate cuts from the Fed, right? Like usually speaking, we were either at zero, or not usually, but like for a long time, we were either 0% interest or like worried about rate hikes. But it's been a long time since we've really seen the market expecting rate cuts. As a result, I think that the velocity of money has declined because a lot of people are sort of, well, not a lot of people, but some market participants rather are sort of waiting for this lower interest rate environment that's coming. And so this injection of M2 that's been building up, and this increase of, like you said, liquidity and credit, I think there's a lot of market participants who are sort of waiting for this cut as a sort of like green light to go take action and like, hey, the lower rates are here. Let's go get involved. Let's take advantage of this environment. Do you think that once we actually get this cut from the Fed, there's going to be this like pent up demand, pent up action that's just going to like let the markets go rip? Or like, what do you think the short, like, yeah, what are your thoughts on that?
So it goes back to what we were talking about earlier. The market is a forward-looking pricing mechanism. And so by very nature of the 1 month and 3 month treasury yields making these multi-month or multi-year lows, that's telling us that the market is priced in a rate cut and a rate cut regime. And so as those rate cuts continue to get priced in, as economic data continues to come in, hopefully that reaffirms that we're going to stay in a rate cut environment. I should be very clear here, a modest rate cut environment, because the last thing I think we want to see is a massive rate cut, because that's generally emblematic of the Fed cutting in response to a crisis. As those things are taking place, the market's already priced that in, right? So again, we've been looking at the market pricing in rate cuts since the beginning of 2024, in my opinion. And that's one of the reasons why the NASDAQ, why the Dow Jones broke out to new all-time highs at the beginning of 2024, is because the market was saying, hey, rate cuts, whether they're coming next month or 6 months or 1 year down the line, they are coming, and we need to start pricing in on net an easing environment relative to a tightening environment.
Gotcha. Okay. I want to come back to Bitcoin here. Thanks for indulging me in the liquidity diversion. You said you're calling for, if I heard you correctly, a 30% rise in Bitcoin from here. Like, walk me through what you think you're going to see from Bitcoin in terms of performance going into the end of this year. Bitcoin, I think so far is up around 20% year to date. So it's had sort of a sideways 2025 by Bitcoin standards, at least. 20% is great in other markets, but what are you seeing for Bitcoin as we go into Q4? How is Bitcoin going to benefit or react to this rate cut environment we're going into?
Sure. So I'm not necessarily expecting 30% upside. My cycle price target for Bitcoin is at minimum 175. I'm willing to entertain prices slightly above 200,000. So I still think that we're likely to get there, and maybe it just takes a little bit more than a year, right? So I'm not sure exactly what that pace is going to look like, but I see nothing, at least in the current market environment, that's invalidating those price targets of at least 175. As I'm looking at Bitcoin right now, there's one very interesting data point that I want to share. I took this last night when we were trading at 111,273. So obviously we've seen a little bit of upside today. But in particular here, what I want to call out is this indicator in the lower pane that I'm using. This is the 60-day Williams %R oscillator. What is this indicator measuring? It's measuring the high and the low over a 60-day time frame and measuring where we are with respect to that high and low range. And so typically what we see is that overbought conditions occur here in the top panel, and oversold conditions occur here in the lower pane. And so what I've identified here is a signal that's only happened 5 other times over the course of this bull market beginning in 2023, which is that we've gone from the top pane, an overbought condition, to the lower pane. We've gone from the top pane to the bottom pane. You'll notice I'm not highlighting this case here because we did not actually trigger an oversold criteria, but we did in all of these other cases. And so this happened more recently. I refer to these as accumulation signals. Historically, at least as we've seen over the course of this bull market, this has given both medium and long-term investors an amazing opportunity to stack Bitcoin before we go through that next decisive leg higher. It's not a bullish signal in terms of what we should expect 1 month from now, but it is an accumulation signal, right? And so I've been using this signal myself to accumulate Bitcoin. The signal did trigger officially at the end of August. And so I've been buying Bitcoin basically between 108,000 and 111,000 in part due to this signal. And so unequivocally, based on this chart, based on this data, based on all of the evidence that I presented earlier, looking at the stock market specifically, we're in strong uptrends. We should not look to fade this uptrend. I have a phrase I like to use very often. Do we want to be a goldfish trying to swim upstream or a salmon trying to swim downstream? I'd always try to be a salmon, right? That's going to be the path of least resistance. The wind is in our sails. And so I want to align with this trend as much as possible. And what this chart is saying is, hey, we're going to align with that trend by using this accumulation signal to stack more Bitcoin.
I think this is a really helpful chart. I don't think I've seen this exact indicator before. So really helpful insight and analysis on this. I think that one of the things that I've seen in the market that's precipitated this, drop down to this accumulation phase you're saying is that we've seen a lot of selling from OGs, from like Bitcoin OGs who've had their coins for a really long time, who are taking profits, cycling out. But, as you said, there's a lot of bullish things still supporting the uptrend here, and a lot of buyers coming into the market to reaccumulate those sold Bitcoin before we're allowed to continue higher here. I love hearing people give price predictions on Bitcoin that are more bullish than mine. I would love to hear a little bit more detail on why 175K is your target there, and why you think it might go north of that, because I got to be honest, that's a pretty ambitious target, and I'd love to hear you talk about that for a minute.
Look, I like to be ambitious, right? And I also like bringing exclusive insights, certain indicators that most people might not see. So that's why I'm bringing this Williams percent R. It's one of my favorites. I think it's one of the most underutilized amongst technicians. Let's talk about my 175K cycle price target. First of all, I came out with that prediction in July of 2023. We were trading around 30,000. So far, we've obviously trended towards that price target. We have not yet hit it, but I've been very public since the middle of 2023 that that's my cycle price target. The way that I came to that conclusion, I don't have the chart with me, but I simply took a Fibonacci extension from the highs of 2021 to the lows of 2022, and I plotted the 161.8% target extension in logarithmic scale. What I did at the time is I looked back at all prior bull markets, and every single time we hit that 161.8% extension from the prior bull market highs to the recent bear market lows, sometimes we've actually exceeded it. And so that level in this current market environment, I think is like 174,000 and change. And I'm just rounding up, calling it 175. But then I'm also saying at least 175, because like I said, we've had some cycles that do go on to exceed that 161.8% price target. And I'm still willing to entertain higher prices than that. But I think my safe bet here is at minimum 175.
I'm willing to entertain anything as long as it's higher than that. That'd be amazing. Look, I want to kind of like, we've said a lot of bullish things. I agree with a lot of this analysis too. I think that there's a lot of things that are causing concern for a lot of analysts, but in general, the bullish uptrend is very strong. It hasn't been broken yet in any major way that I can see. So I think there's reason to assume that that'll continue. I want to get your thoughts on what might invalidate that thesis for you. What might cause you to switch your view on this and say, like, we've pivoted now, like you said, a salmon swimming upstream, or your metaphor was really elegant. I can't remember it exactly right now, but like, what in your mind are you looking for to see that indicator that, hey, this is no longer a strong bull trend, we've switched bearish? Like, is there something that you're particularly looking at? Is it like a series of factors? Like, what in your mind would change that thesis for you?
So yeah, this is what I spend a lot of time thinking about, actually. And so first of all, it's going to be a deterioration in the trend. And over the course of however long you want to call it, but basically the past 2.5 years, we've been in a market environment where we continue to produce higher highs and higher lows. We can go through consolidations, but they tend to resolve back to the upside and produce new highs, right? And so what would make me nervous is if we start to invalidate those higher highs and higher lows, and we start to do the opposite. We start producing lower lows and lower highs. Like I mentioned earlier, I'm an economist, but I put myself as a technician first. And part of being a technician is looking at market relationships and certain things like credit spreads. And so this is looking at the high yield credit spread index from Bank of America. This has not yet made new cycle lows, but generally speaking, what this is looking at is the difference in yields between junk bonds and US treasuries over basically the same duration of time. And so this is giving a really clear sense. When this variable is moving down, when this line is going down, it means that that spread is getting compressed because investors are perceiving less risk about the future. When it goes up, it's because they're perceiving more risk in the future. Why is this chart so important? If we invert this chart, if we flip it on its head, and instead, what we do is we overlay the Russell 2000 in the lower pane. Do we notice anything here, guys? When the market is perceiving lower risk, when credit spreads are falling, or in this case, because I've inverted it, when they're rising, good things tend to happen for the Russell 2000. When credit spreads are rising, but because I've inverted it, the chart is going down, we tend to see the Russell 2000 go down. So when I look at this chart right now, not only am I just being a stock jockey and looking at what's taking place in risk asset markets, but I'm also looking at credit spreads. I'm looking for confluence here between these two indicators. And what they're telling me objectively, unequivocally, is that the smartest investors in the world in the credit markets are not perceiving an elevated level of risk. And that's being confirmed by equity market investors by the very nature of the fact that the Russell 2000 is trending higher. All of those charts that I started off talking about are making new all-time highs. I brought plenty more too, right? So those charts, we're seeing all that production of new all-time highs. So what would make me nervous is if this chart starts to go up again, but we're not going up. It looks like we're poised to make new lows here on credit spreads.
Gotcha. Yeah. I think that the insight of showing that inversion, that relationship, it's really helpful. And that's one of the reasons why I love your work so much, is that you use non-traditional, or like, let's say, indicators and analysis that are not things that most people look at, but that have a really great ability to make things clear and trends that people can understand and make sense to people. So I really appreciate that. We're coming up on time here. I want to, I know you, like you said, you brought tons of alpha to share with us today. But I want to kind of say, with macro, something I feel like a lot of people struggle with is distilling things down into something that's simpler and easier to understand. We're going into Q4. The Fed's going to start cutting rates. What is the most important thing for investors to pay attention to in Q4, or what's top of mind for you? Is it the stock market? Is it gold? Is it Bitcoin? Is it, some other thing that you're looking at? What is the thing that's most important for investors to watch as we go through Q4 here?
If investors are focused solely on making money, the only thing they should pay attention to is asset markets and asset prices themselves, and reaffirming that they're still in uptrends. And we can look at some of these intermarket relationships that we've gone ahead and done. We can look at high yield credit spreads to reaffirm that in different ways. But unequivocally, if you're focused on making money, you should probably pay as little attention as possible to macroeconomic data, and as much as possible to what asset markets are actually telling us is taking place, right? Because you can ask 100 economists what's taking place in the economy today, you're probably going to get 90 answers. If you ask 100 technicians what's taking place in the market today, you're probably going to get 5 or 10 different answers, right? So a much tighter spread of outcomes. And I think that's really, really important. The thing that's, if you want to just be an armchair economist, and that's totally fine, a lot of people like to sound smart by just talking about macro in and of itself, is you really need to focus on labor market data. You really need to focus on what's taking place in something like job creation, which is slowing down significantly. So if we look at the difference in job creation last August versus job creation today, we're seeing a significantly how should I say this? It's slowing down, right? In plain English. So if this continues to slow down, but actually starts to contract, that would be a big cause of concern for the Fed. It would be a big cause of concern for the markets. This is not something that we should be dismissive of. This is looking at it on a trailing 6-month basis, average job creation. If we look at it on a 3-month basis, we see an even worse picture here, right? So jobs are really slowing down. Job creation is really slowing down. We have an environment here where those cracks in the labor market that I've often been dismissive of are starting to actually become more of a concern here. They're not enough of a concern for me to be bearish, because we still have significant uptrends taking place across the entire market environment, but it's enough for me to be aware of it here and now, right? And just say, okay, this is something to keep in mind. We need to continue to affirm that markets are being dismissive of this data or seeing through this data, because, hey, look, at the end of the day, I'm here to make money as an investor, right? I'm not here to sound smart. I'm not here to wear a monocle and be in some shady back rooms talking with guys with gray hair, talking about what's taking place in the economy. I'm here to make money as an investor, right? And hopefully that's what other people are here to do as well, which means that above all, we should be focused on what the market is doing itself.
I like to say that bears sound smart and bulls get rich. And I think that's kind of what you're getting at here, is that there's a lot of analysts and economists who do a lot of research and insight and all of this alpha and generation of charts and data and forecasts. But the real thing is, what is the market actually telling you? And I think that's a great piece of wisdom to leave our audience with. Thank you so much for being here. I learned a lot. I'm sure our audience did too. Where can we send people to find more of you and your work online?
Just check me out on Twitter, man. It's my first and last name, Caleb Franzen. It's my only account, so don't follow any of the scammers who are trying to impersonate me. It's just Caleb Franzen, just on Twitter. Or awesome, on X, man. I should say. My God.
Yeah. Yeah, well, either place you can go. I'm sure you're going to get a lot of alpha and insight. So I encourage our audience to go check you out. Caleb, thanks so much for being here. Like I said, I learned a lot. I had a great time. I hope you did too. I hope we can have you back again soon, man. This was really great. Thank you.
Thanks for having me.
And thank you, everyone, for joining us. We will see you on the next episode of Milk Road Macro. Until then, stay bullish and stay educated, stay safe, and we'll see you all again soon. Thanks for being here. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.